If you're thinking about selling real estate, one of the things you need to keep in mind is the amount of taxes you're going to pay on that sale. There's a whole lot of money involved in selling property, and anytime money swaps hands, you can bet that Uncle Sam is coming for his piece of the pie. Now, Uncle Sam's piece of the pie is called the capital gains tax. And the capital gains tax on real estate works a lot differently than other forms of taxes. So today we're gonna take a close look at the capital gains tax on real estate, and I'm also gonna give you 2 strategies to avoid this tax altogether. Welcome back to the channel, everyone. My name is Sherman, a CPA here at Life Accounting, on the #1 channel on YouTube for helping you save more money on taxes and boosting profits in your business. In this video, I'm going to break down the capital gains tax on real estate transactions to help you understand what they are and minimize any taxes you might owe. Now, of course, this is not legal advice, and I'm making this video for informational purposes only. But if this explanation helps you out in your journey at all, please let me know by clicking that like button below. All right, let's talk about the capital gains tax. First of all, what is the capital gains tax? The capital gains tax is a tax on capital assets like stocks, bonds, homes, and other types of assets. Now, you are only assessed a capital gains tax when you realize a gain. For example, if you bought a home and that home appreciated by $100,000, you would not pay any capital gains taxes based on the fact that your home simply appreciated. But the moment you sell your home, then you realize the gain and would be subject to capital gains taxes. So basically, you are only assessed a capital gains tax when you sell your assets. And you would only pay capital gains tax on the difference of the purchase price you paid for your real estate and the sales price. For example, if you bought a home for $200,000 and later sold it for $300,000, you would only have to pay capital gains taxes on the difference of $100,000. Now let's discuss the 2 types of capital gains taxes. In a moment here, I'll tell you how you can pay no capital gains taxes at all, but let's first look at the 2 basic types that you need to be aware of. The 2 types of capital gains taxes are short-term and long-term capital gains. A short-term capital gains tax is assessed when you sell a piece of property that you've owned for less than 1 year. And on the other hand, a long-term capital gains tax is assessed when you sell a piece of property that you owned for greater than 1 year. With that said, you may be wondering, why does this matter and which type of capital gains tax is better? Well, both of these taxes are actually taxed differently. At the time of this video, short-term capital gains are taxed as part of your ordinary income, which means you would pay ordinary income taxes on the sale of your real estate based on the tax bracket that your income places you in. For example, if your income puts you in the 30% tax bracket, your capital gains tax will be taxed at 30% as well. Long-term capital gains, on the other hand, are taxed differently. It is still based on your income to some extent, but the taxes are limited up to 20%. For example, if you're single and earn over $40,000 per year, but less than $430,000 per year, then your capital gains tax would only be 15%. As you can see here, long-term capital gains are more favorable in terms of tax treatment. In this example, the difference of 15% on a $100,000 capital gain would save you $15,000 if you're in the 30% tax bracket ordinarily. But what if you did not have to pay any taxes on your capital gains? Like, what if you could avoid this tax altogether? Fortunately, there are a couple of ways to minimize or avoid these taxes altogether. So let's look at these 2 tax strategies. Tax strategy number 1, Section 121 exclusion. This tax strategy is for people who are trying to sell their primary residence. If you're selling investment property, then just hold on for a moment here because I have a tax strategy for you as well. Section 121 of the tax code allows homeowners to exclude a portion of their capital gains when they sell their primary residence. If you're single, you can exclude up to $250,000 of the capital gain. And if you're married, you can double this and exclude up to $500,000 of the capital gain. Now, there are a couple of requirements here that you do need to be aware of. The main requirement that trips most people up is that you must have lived in the residence for a minimum of 2 years during the most recent 5-year period. So if you only lived in the residence for 1 year and sold it, you would not qualify for this exclusion. But on the other hand, let's say you lived in the residence for 1 year, rented it out for a couple of years, and then you returned to live there for another year again, then you would qualify in that scenario. The 2 years you lived in the residence does not have to be consecutive years, but you do have to live there for 2 years. All right, tax strategy number 2. 1031 exchange. This tax strategy is used by real estate investors to defer capital gains and build wealth. A 1031 exchange is a swap of one investment property for another investment property. Basically, it allows you as the investor to sell one of your properties and subsequently acquire another investment property without realizing any capital gains. You're essentially replacing one property with another property to eliminate your capital gains taxes. However, you must acquire the next property within a specific amount of time in order for it to qualify as a 1031 exchange. There's 2 time limits. The first time limit is that you have 45 days from the date you sell the relinquished property to identify potential replacement properties. And the second time limit is that you must close on the replacement property no later than 180 days after the sale of the exchange property. Now, there's a lot that goes into a 1031 exchange, like the property being like kind and other stipulations. So be sure to subscribe to our channel to learn more about how all of that stuff works. But ultimately, that's how capital gain taxes work on real estate transactions. And those are 2 strategies for you to avoid paying those taxes altogether. That's it for today's episode, everybody. If you enjoyed it, please hit that subscribe button below and we'll see you in the next video.